In this week's episode, we look at the latest movements in the Zambian maize market and also discuss the factors driving these prices. All in this week's episode, so make sure to stay tuned. Hello, Dr. Johnny van der Merwe here, and a warm welcome to another episode of the African Agri Overview, thanks to the support of Fieldnet Pivot Watch, Comdi Grain Trading and Collateral Management International. Join the excitement around Fieldnet Pivot Watch. Experience unmatched monitoring of any pivot, anytime, anywhere, offering complete peace of mind on your farm. Fieldnet Pivot Watch is not only cost-effective but also time-saving. Ready to transform your irrigation? Contact your nearest Zambia dealer for a quote on Fieldnet Pivot Watch now. In the Zambian poultry market, we have seen day-old broiler prices increasing to 16.17 kwachas per head, while day-old layers decreased to 20.5 kwachas. Layer cull prices increased to 87 kwachas, while live broilers decreased to 103 kwachas per head. The average egg price increased again and traded on 74.67 kwachas per tray. We're also expecting egg prices specifically to remain on a higher level over the next month or so. Looking at the latest grain price movements in Lusaka, we saw the maize price increasing to $330 per ton, while the wheat price decreased slightly to $490 per ton. The latest soybean price increased to $630 per ton, while soy meal prices traded sharply higher again on $650 per ton. Collateral Management International, or CMI, operates across the continent to manage and control commodities financed by financial institutions. With over a decade of experience, CMI is known for top-tier storage standards and trusted staff. They specialize in collateral management, commodity storage, stock monitoring, and inspection services, balancing security and operational value for banks and clients. CMI, your leading collateral manager in Africa. But with that, let's jump straight into the latest news on the African grain markets.
Welcome to all our viewers. This week, we look at the Zambian maize market, where the recent government crop size estimate came in way below market expectations. Zambia needs to import substantial maize volumes for the first time since 2004. Let's start by analyzing the expected maize balance sheet for the 2024-25 year, running from April 2024 to March 2025. We will use the government's forecast numbers as they have proven to be reliable over many years. The government released their crop estimate late May at 1.5 million tonnes, significantly below market expectations of around 2 million tonnes. Their carry-in stock estimate is at 400,000 tonnes, therefore 1.9 million tonnes available for consumption. Government's consumption estimate at 2.5 million tonnes, excluding the strategic reserve. They normally target a 500,000 tonne strategic reserve, so the import need is around 700,000 tonnes excluding the reserve. If one includes the strategic reserve, the need jumps to 1.2 million tonnes. Given the large import need this year, the government might have to settle for a smaller reserve, say around 300,000 tonnes. This will leave Zambia with a 1 million tonne import requirement. Zambia should attempt to import the entire deficit from Tanzania, as previously mentioned. Zambia already importing substantial volumes from Tanzania informally. Formal imports are still impeded by non-tariff barriers, which add costs informal imports do not have. Given the expected maize shortfall for most of Tanzania's neighbours, including Kenya, Rwanda, Burundi, the DRC, Zambia, Malawi and Mozambique this season, a relevant question is if their exportable surplus, roughly estimated at 2 to 2.5 million tonnes, will be sufficient. We are not entirely convinced. This is all the more a reason the Zambia government should make formal imports as easy and cheap as possible as soon as possible. This graph indicates the Lusaka maize price history. Tanzanian import parity should play an important role in Zambia price determination this season. The next long-range Tanzania harvest expected to be a bumper crop slowly getting underway and should get real momentum from the second half of July. We guess Tanzania prices could be impacted by harvest pressure short term, and insufficient storage space could also play a part. The red line indicates spot Tanzania import parity Lusaka at $320 a ton, in line with the Lusaka price. With Tanzania prices already relatively low, we do not expect import parity will decline much below $280 a ton. See the blue line. However, once the Tanzanian harvest is complete by late September, their price should recover on strong expected export demand. If the Tanzanian supply falls short of the Zambian import need, we believe their most likely other non-GM option is yellow maize imports from the Ukraine for the feed industry. Current Ukraine import parity at $400 a ton. See the yellow line. We expect the Lusaka price could spend most of the next 10 months before the next crop is due mid-2025 above $300 a ton. Next week we will revisit the Tanzania maize market. Although we discussed this market recently, we feel the relevant question if the Tanzanian exportable surplus will be adequate to meet its neighbors' import needs must be analyzed. Remember, quality information improves decision making. Contact us for more detailed, tailored information.
Thank you, Jock. A huge shout out to our sponsors, Fieldnet Pivot Watch, Comdi Grain Trading, and Collateral Management International for making these videos possible. Comdi is a seasoned grain trading expert in South Africa's dynamic marketplace with years of experience and a reputation for excellence. Comdi leads the way in connecting markets and facilitating grain trading across Africa and beyond. Comdi, your trusted partner in South African grain trading. I'm Dr. Johnny van der Merwe. Thank you for watching, and remember to tune in next week for more on the African grain markets.